A company called Nebius just signed a $27 billion contract with Meta. Billion, not million. And so who is Nebius? Nebius is a company that provides GPUs as a service. Basically, they will buy the GPU and then they will lend them out to companies that are training AI models. And in today's scenario, what we're going to do is we're going to break down Nebius's most recent contract announcement with Meta. So the total contract value was $27 billion, which is basically comprised of two components. The first component is $12 billion over 5 years, and the second component of the contract is worth $15 billion. And that $15 billion is basically Meta telling Nebius, if you have any remaining or unsold compute capacity, basically GPUs that are not used within the next 5 years that you cannot sell to other customers, we will take all of them. And that really just shows that right now within the broader AI sector, there is not enough supply and a lot of demand. For Meta to come out and say, yeah, we'll basically take anything left over that you can't get rid of, is a really good thing for Nebius, because that basically just locks up all of their excess capacity or unsold capacity in the future. Now, for Nebius, what does this look like in terms of financials and unit economics for this one contract? That's what we're really going to look into today. And so you can see me here building out a very simple template. And a lot of these contracts, they don't actually disclose everything that you need to figure out the IRR or the payback. And what I've done here is I've leveraged a lot of peer analysis, looking at what CoreWeave has done, looking at what IRN has done. And so a lot of these neoclouds have announced all these big contracts, in particular with Microsoft, Meta, Google, OpenAI. And they don't disclose everything, but your best guess would be that how one company has structured the deal would be the industry norm across the street. And so you can see that previously I had looked at CoreWeave to grab an EBITDA number. And then here you can see what I'm really trying to do is figure out the number of GPUs that are required for Nebius to deliver the $27 billion that it has signed with Meta. And the reason is because without knowing the number of GPUs, you can't actually tell how much Capex is required. And without knowing how much Capex is required, you won't actually know how much money Nebius has to commit, including how much in borrowings they need to go out and get to fund this. And so what I've done here is I've looked at the Microsoft contracts, I've looked at them signing with Nscale, IRN, Nebius, and roughly people are coming out at around the high, like you can see here, Nscale is at $2.74. And then I'm just calculating IRN here, which comes out, I think it should be around $2.80 something. And the way you calculate these hourly GPU rates is to get the total contract value divided by the contract length, which is typically 5 years right now in the industry. And then you get an annual revenue number. Now, with that annual revenue number, if you know the number of GPUs, you can obviously figure out what the hourly GPU rate is approximately. And that's assuming, 365 days and 24 hours of utilization. But obviously, this is not going to be the case with all of these GPUs. But the reason why we're taking these numbers is because this is our best guess based on what has been publicly disclosed. Now, obviously, if you were to actually rent these GPUs on an hourly basis as opposed to signing a 5-year contract, your rates are going to be much higher than this. But here you can see Nebius was at $3.97, not sure why. So I took the conservative route here, which was to just take the average of the 3 contracts that Microsoft had announced, and you're coming out around $3.18. And so then what I did was I took that $3.18, and the next step is to calculate how many GPUs. And so the way that I approached this was that I looked at the annual revenue, which was around $5.4 billion, and I calculated what the annual income rate of one GPU, because that $3.18 is for 1 hour, but over the course of a year, how much would you expect to earn from that GPU, which is around $28,000. And so you take the 5.4 billion divided by the 28,000, and you get to around 195,000 GPUs. Yeah, 194,000 GPUs. And so that's, roughly in line with what you see in the benchmarking table below, because the contract value is double. So, having roughly double the amount of GPUs makes a lot of sense. And then the next bit, which was a bit more tricky, was trying to find out how much debt these guys were going to need, and also how much is the cost of one GPU. And this is pretty hard because you have to link the Capex number to the number of GPUs. So I was lucky enough in that IRN had previously disclosed they were going to spend around $5.8 billion to fulfill one of their contracts, and they actually disclosed the number of GPUs that they needed. And so based on those numbers, you could actually figure out that one GPU would cost IRN around $73,000. Now, the assumption is every single neo cloud, every single N-scale, IRN, Nebius, CoreWeave, they're all buying from the same supplier, which is NVIDIA. And so the pricing should be very similar. And if you take that price of $73,000 and you multiply it by the number of GPUs, you get to $14 billion of Capex that is required to deliver on a contract that will give you $27 billion of revenue over 5 years. Now, I was initially, the number was so big, I actually had to double check this, but yes, it is $14 billion. And it's interesting here because Nebius can go spend $14 billion and buy all of these GPUs. But once this contract is done with Meta, after 5 years, in year 6 and onwards, they still own the GPUs that they can continue to lease out. But obviously, in 5 or 6 years, we don't know how capable these GPUs are and whether they'll be in demand, but at least there'll be some value. But that is obviously not something that we're considering here, because on a conservative basis, let's just assume that they're worth nothing. And then we're going to have a look at basically how do they fund their Capex purchases, because $14 billion is a lot of money. And basically a lot of these neo clouds actually go out and they borrow money. So usually it's delayed draw term loans from various banks, or they try and raise convertible bonds or raise equity. But obviously raising equity dilutes your existing shareholders, which is not something that has been looked upon favorably. But you are seeing a lot of these companies, especially Nebius, doing convertible notes, which is basically a bond that gives the lender the option to convert in the future. And so you're not exactly diluting your shareholders now, but you do put in a conversion price. So you're effectively locking in a value in the future. But at the moment, you're not diluting anybody, and because you give them that conversion right, the actual interest and bond cost is actually a little bit lower than what you would do if you got a traditional debt product. And so what you see here is typically what they do is they have a loan to value ratio of around 70%. So effectively, most of this is being bankrolled by financiers and banks. And so taking the 70% of the 14 billion, you get to around $10 billion. And then the last part of the equation is to actually figure out what is the interest expense on these types of loans. And to my surprise, when I did Google this and search it up, it did look quite high. And so you're looking at around here, so you're looking at around here, on top of the SOFR, you're looking at a margin of 4 to 9%. So your total cost is around 9 to 11. Taking the midpoint, around 10%, that implies an annual interest expense of $1 billion. $1 billion every year to finance these GPUs. That is a really big number. And this is the scale that we're looking at, where this is just in Nebius. There are other providers such as Iron, CoreWeave, NeoCloud, and other NeoClouds that are doing the exact same thing. And every single company is taking on billions of dollars of loans to fulfill the massive revenue contracts that they have. Now, these revenue contracts are typically locked. So if Meta signs a contract with Nebius, you can't actually get out of it. So even if Meta decides to never train their models, they still have to pay Nebius the full $27 billion. Now, obviously, in this case with Meta's contract, the second proportion, the $15 billion, does depend on excess capacity that Meta is unable to sell. But the initial $12 billion, that's contracted. That doesn't disappear. And so you can see me building out the P&L here. And for the DNA, which I forgot to mention, that's basically just the 5-year contract term. So you just assume that over the course of the contract, the GPU depreciates. And so using 5 years, you get around 2.8. And then here I'm just filling out the tax rate and getting to a profit and P&L loss item, P&L item, line item here. And you can see here, from a P&L perspective, you're actually loss making. And so what's interesting here is that from a cash flow perspective, you are actually cash flow positive. Because of that DNA amount of $2.8 billion, that's not an actual cash expense. And so every year, if you actually adjust the P&L and you actually have a full cash flow statement, you are actually generating a lot of cash. And so the question is, with all of those cash flows coming in, is that a sufficient return or an attractive return for the business? Sure, you can be cash flow positive, but from an IRR perspective, how does that look compared to the other contracts and the other investment opportunities or use of capital that an investor could have with their own cash? And so you can see here what I've done is I've started to build out a cash flow statement starting from the P&L, and then I've added back the significant amount of DNA, which you assume 5 years based on the contract term. And then here what I've realized is that previously I assumed there was no debt repayment, but theoretically if you assumed a debt repayment, you would actually pay less interest expense over the course of the contract, just given the timing. And so your opening balance for the debt schedule would be the $10 billion, which is the 70% of your total Capex amount of $14 billion. And you just assume, making a simple assumption, assuming that it's an equal repayment over the 5 years, which comes out at around $2 billion. And then here for the interest expense, I've just taken the average of the starting and closing balance, but you still assume the 10% interest expense. And then what we're going to see here is that the interest expense does decline. So at the start of the period, you're towards $1 billion, but as you start making significant repayments to the debt facility, you can actually drop your interest expense. And obviously if you do that, more of those cash flows will come to you. Arguably, by doing that, you are reducing your IRR, because what would happen is that instead of those cash flows being distributed to shareholders and investors, you're actually directing them towards the facilities. But given that some of the banks would probably implement amortization schedules, it's safer to assume that in a conservative scenario, you would probably need to repay these, because based on the fact that if you had $2 billion extra every year, you're probably looking at around maybe, I would say above 20-30% IRR, but the banks wouldn't let you actually redistribute all of those to shareholders without paying them down first. And so conservatively just assuming repayment is the best option. And it's interesting here because if you assume that they repay the debt every year, you're going to get an IRR of negative 3%. And effectively what that implies is that this is not a great investment. Now, I think the really important thing here is, as a company, when you look at this, yes, it is a negative IRR at negative 3%, but at the end of your 5 years of contract, you actually still have the GPUs, which you can still lease out and lend out to people. And so when you think of it that way, you're actually really having a lot of upside after the 5th year, which is not being included. And then the other thing I picked up was that CoreWeave had a long-term EBIT margin of 25 to 30%. And so if you actually benchmarked this contract that Nebius had signed with Meta towards that 25-30% range, you actually get a much higher IRR at around 24%. And so obviously, if you actually can achieve that cost profile, it is actually quite an attractive contract for Nebius to enter into. And so, there are a few moving parts and there are a few different ways you can think about these contracts. But what is clear is that at a certain EBIT margin, or at least what the neoclouds are saying they want to target, they're really looking at an IRR of 24%, which is something that's similar to what private equity returns are. And this is just for one contract. And then on top of that, after the 5th year, they get further upside from further rental income from leasing out those GPUs. I mean, sure, in 5 or 6 years, those GPUs might be not as powerful as they are today. They might be not the latest generation, but there's still some value. And whatever that value may be, that's a risk that Nebius has taken on, that the value of those chips, that risk of whether it will be worth anything, will be borne by Nebius. And if you actually look across the sector, I imagine a lot of these neoclouds are doing the exact same thing and structuring the deals the exact same way. And it is interesting to see how the risk dynamic is being shared between the big hyperscalers such as Microsoft, Google, Meta, and against the neoclouds who actually have to take the risk in some cases. Otherwise, they will have to improve their cost profile and get there in the first 5 years in terms of returns, or they're just banking on the salvage value of the GPU afterwards. If you found this video to be useful, please like and subscribe, and please also comment below and let me know what are your views of this as well. Obviously, it's a fast-changing industry. Would be interested in hearing what everybody thinks.